of IBM or something.
Oh,
So
maybe.
go ahead. Question?
Oh, sorry, I didn't realize.
Okay. Company may invest to buy stock in another company, just like you and I might. Okay. And there's three different thresholds we're going to talk about in this chapter. One is what's called a passive investment, where you just buy a certain amount, small amount of the company, and you're totally independent from them. But if you buy more than 20% of the company, you're said to have what's called in accounting significant influence. And the rules get different at that point. Or you buy 50% of the company, over 50%, it's now a new company under your control. Passive investments. We're not going to go in this chapter. We're not going to go worry about bonds. We already know how to amortize bonds. But this is an important point. All debt securities are passive. All debt, all bonds are passive investments, meaning that the investor is not interested in influencing the company really. The purpose of a passive investment is to earn some kind of return, some income. Equity security investments, meaning stock, they are presumed to be passive if you own less than 20% of the outstanding shares. 20% of the outstanding shares, it's called passive. You're totally independent from the company. The second threshold we're going to go over briefly is if you own 20 to 50%, say 49.99. Here, you're said to have significant influence, and you buy that much stock in a company, it looks like you intend to exert that influence. If you have this much stock, you have the ability to have an important impact on the operating and financial policies of the company. You own 25% of a corporation's outstanding shares. That's a lot of influence. It wouldn't take long to get together with some other smaller shareholders and vote as a block. A lot of influence. Accounting rules are different. And the third, you buy over half the shares. Now it's a new company. You own the company. You can do whatever you want with the company. You will determine the policies, what they're going to do, if they're going to grow and how they're going to do it vertically, horizontally, or synergistically. I love that word. So here we go. Types of investments. Remember what we said. All debt is passive. All debt. Bonds are passive. Now we're going to get into the three methods we're going to review in this class today. The passive uses what's called the fair market value, significant influence equity method, and then if you have
control, you're going to be able to prepare consolidated statements. So we're not going to look at debt. We've had a lot of looks at debts in the last couple of chapters. So I'm just going to go ahead. The rules are the same, but I'm just going to go ahead here. Okay, here we go. Stock investments. Stock is what we're talking about. If you go out and buy, you're a corporation, and you go out and for some reason you buy 100 shares of Coca-Cola, like me, 100 shares of Coca-Cola, you obviously have no influence over Coca-Cola. Your vote is tiny, barely noticeable in an ocean of outstanding shares. So you are separate from the company. What happens to the company doesn't happen to you. If the company issues a dividend check, great, you got money, that's your income. If the company wants to do something big, you have no influence over it. You are passive, okay? Now, here's something that we're introducing that's brand new. You've heard me talk all semester that everything on the balance sheet is carried at historical values. And that's my story, and I'm sticking to it. There is this one exception, though, and that is if you have a passive investment in another company, you must record the value of that asset at its market value at the end of each year, or perhaps the end of each month or quarter, whatever you're doing. So here is the first example you will see of seeing what the market value of an asset is and writing it up to its market value. And we'll talk a little bit about this. Obviously, we'll talk a lot about it. So that would be called an unrealized gain. You're recognizing the fact that your stock has gone up in price. So your investment, of course, is recorded at cost, but we are going to look at it every period and adjust it up and down as needed to reflect the market value. The market value. So we're talking stock, okay? Stock. And now we're going to break it out into two categories: trading securities and available for sale securities. The rules for these two different categories are pretty much the same. The journal entries are the same. The only difference between the two is how the net income is reported. And this chapter is a little tricky. You have to go through your homework assignments, get familiar with some of these terms, okay? A trading security is one that the buyer is very likely to sell fairly soon, within a year, say. This is an investment where you're going to maybe sell it and buy it back later. You're going to be actively trading it. That's called a trading security. The other half is if you buy the same exact investment, the same exact dollars, and you don't plan to actively trade them. You bought 1,000 shares of General Mills to collect their dividends, say, and you're just going to sit on it. That's called an available for sale security. Available for sale security. And again, the only difference in the treatment of the two is at the time you record income. That is what we really need to hit now as we move along here. We're using the fair market value method. We're using the fair value, the fair market value method of recording a treasury security or an available for sale security. The fair value of an asset is the amount that you would receive in an orderly sale. To measure fair value, accounting standards recognize three approaches in order of decreasing reliability: quoted prices in the active stock market, estimates based on other inputs, estimates based on unobservable estimates, the company's own estimates. What we're saying here, Brianna and everybody, is unlike a piece of land, unlike a piece of equipment, where you cannot really put a number on the market value, here you can to an empirical certainty. You can find out what that investment is worth, what that trading security is worth, or that available for sale security is worth, by Googling the stock market. Google Coca-Cola and Whammo. That's the value. There's no question about it. There's no ambiguity. So this is the one exception where every period in this book, they do it every year, we're going to adjust to the fair market value. So let's get started here. Let us begin. And I need to move this over here. Get this out of my way. There we go. Okay, we're going to start with securities available for sale. Remember, these are the ones that we're going to hold for a while. And that's going to affect how we record the income at the end. So let's see what we have here. We have Graham Holdings. They buy 15,000 shares of iNews. 15,000 shares. 15%. That is below 20%. So we know that it's going to either be a trading security or an available for sale. And you're not going to have to figure that out. They're going to tell you that in the problem. That's the whole point. We're not trying to keep that part of it a secret. So should they be trading securities or available for sale? Graham has no influence because it's under 20% and does not plan to sell the shares in the near future. That makes it an AFS, available for sale. Okay. Now let's start talking some journal entries and understand the flow of this stuff. On the 15th, they bought those 15,000 shares. Graham Holdings does not plan to actively trade, so they are an available for sale security. Guess what? It's time to record. It is time to record the purchase of this investment. And that's not too tough. That's not too tough. What's tough is moving these slides around. Okay. They bought this investment. What's this investment called? It's an investment in an available for sale security. So that's not too tough. They bought it for $150,000, 15,000 shares times 10. Let's go on to see what happens in the future. Back to the future. Now they got a dividend from iNews. They got a $15,000 dividend. I'd like to have money in this company. They're paying a $15,000 dividend on a $150,000 investment that quickly, 10%. Great investment, Graham. So they received a dividend. That's not too tough. You debit cash and you credit dividend income or dividend revenue. So the first two transactions are not hard, I don't believe. You record the purchase of the asset and you record any dividends you may receive. That happened on July 2nd. Remember, they bought this investment in, we'll double check the date. They bought it at the beginning of 15. Beginning of 15, okay? Here is the dividend, cash dividend income, dividend revenue. Aha, now look what happened. Remember, we bought this at the beginning of the year? This investment, unfortunately, has dropped quite a bit. It went from $10 a share to $8. It's lost 20% of its value. Good gosh. Well, remember now, the whole point of this chapter here is to learn these different methods. We are going to have to record this as an unrealized loss. Unrealized. So let's take a peek here. We purchased it for 10. We paid 150. Now the stock is only worth 120. That is super accurate. That is a precise point in time value at the end of the year. Just pick up your daily newspaper or go online and you'll see what this stuff is worth. So this stock has gone down in value by $30,000. Now here is a brand new journal entry to record this reduction in value. Well, you're going to credit the investment. The asset is $30,000 less than its original cost. But look at this brand new account here. This account is an equity account. Equity account. This journal entry here does not touch your income statement. It is not an expense. It's not a revenue. At this point, what we're saying is this investment went down by 30,000 and thus our equity also went down by 30,000. These are balance sheet accounts. Capital, asset. The unrealized holding loss, unrealized, is reported in the equity section as what they call other comprehensive income. At this point, it's all balance sheet. The asset goes down and you reduce capital accordingly, okay? Okay, now it's a year later. It's a year later. Hey, look at this. Good thing we didn't sell, huh? When it went down to $8 a share, because at the end of the following year, it went from 8 to 11. Wow, that's good news, huh? It went from 8 to 11. It went up like 38% or something. Pretty darn good, huh? So just like we had an unrealized loss, now we have an unrealized gain. And what we are going to do is multiply 11 times 15,000. And we had moved it from 150 down to 120. The difference of 45,000 is going to be a debit to the unrealized and a credit, or in this case, it'll be a debit to the investment and a credit to the unrealized. So let's take a look at that. The market value went up $3. We figured that it went from 120 to 165. Look what we have here. We have an investment that has gone up, it's increased, and therefore the capital has risen as well. So hopefully we're starting to get the feel that we're tracking the market value and adjusting these passive investments. Passive, meaning under 20%. You're totally independent from the company. They give you a dividend, that's yours. No games to play, okay?
Professor, what is
Yeah.
OC? What does the OCI stand for?
Other comprehensive income.
Okay, thank you.
Good question. Available for sale. Now look at this. We had bought this stock for, what was it, $10 a share. It went down to 8, so we reversed it down to 120. It went up to 11, meaning that it was worth that whatever it was, 165. Now we're selling this investment. We're selling this investment. So we sold it for $13 a share, and we are comparing that to what we originally purchased it for, and that's $45,000. Okay. Now you might be saying, well, yeah, wasn't it 165 when we finally sold it? Yeah, and shouldn't the difference then be maybe 30,000, not 45? Not really, due to the treatment. So let's see what we're talking about, and say hello to a very, very important T account. Okay, this is called see where it says new unrealized losses and gains. Change the W to a T, please. That should say net unrealized. So let's see what we have here. We credited the asset for 30,000 after the first year, when the stock went from $10 a share to $8 a share. $2 times 15,000. So there we had a loss of $30,000. Okay. Then the next year, when the stock went up to 11, we had an unrealized gain of $45,000. And then we sold it. We sold the stock. So let's see what we have here. We are going to debit cash for 195, and the asset is now valued on our books at 165. So we're going to show it this way. So let's look at this and chat about it a little bit. We sold this asset for $195,000, okay? 195. We know that it was carried on the books at that time at 165. So the difference is 30,000. That's pretty clear. But keep in mind, please, I want to go back to that T account. keep in mind that we had this $15,000 balance here. So this must be debited. So 15 minus the 45,000 we actually did gain gives us this journal entry. You debit cash, you record the net, whatever the balance is in the net unrealized account, which is a stockholders equity account. You credit the investment for whatever it was valued at that point in time. Therefore, the gain is $45,000 over 3 years. But we have left 15 in the unrealized. 45 minus 15 is 30. We originally paid 120 and we sold it for the 195 after we had bumped it up to 165. Now it's kind of babbling there a little bit, but take a look at this journal entry. You need to understand this. We purchased an asset and we sold it now. We received cash. We must clear out that equity. We don't have that equity anymore, so that has to be zeroed out, in this case with a debit. And we had moved the value up to 165. This plug-in figure, if you will, is going to be recorded as a gain on the investment. Gain on the investment. That is a gain that accumulated over 3 years. We bought the stock for 120 and eventually it went up to 165. Okay. Now, trading securities, these are the ones that we do actively sell. Okay. We think we might be buying this today, selling it tomorrow, buying it a week later. We're going to be real players here. Okay. Trading securities. Now, we just went through the AFSs, right? The available for sales. Trading securities. The journal entries are exactly the same, except at the very end. So I think it's worthwhile to go through these journal entries once more. So here we go. Well, look at this. They bought the same exact investment, only this time they're going to be buying and selling it for a while. There we go. Investment in trading securities, current asset, credit cash. Not too tough. Investment, notice what it says, investment in TS, trading securities. And for the rest of this class, I'll put $1 in the pot for every time I accidentally say treasury stock. That means trading securities, okay? Trading securities. Well, they got a dividend. That is the same. Hey, we got a check in the mail, 15,000. What a great dividend, 10%. Debit cash, credit to income. And guess what? The stock went down by $2, remember? And that means that it went from $10 a share. I'm sorry, here's $10 a share to $8 a share. There we go. We purchased it for 150. It went down 20%. We have an unrealized loss here of 30,000. Notice that journal entry is exactly the same as the AFS. Here, the difference is the unrealized holding will be in the income statement, but let's not worry about that. Let's skip that line there right now, because I want to concentrate on the journal entries, how they are the same exact match up until the end when you sell it. Trading securities. Well, it went up to 11 and we're looking at the same numbers. We're looking at the same numbers. Now our stock is valued on our financial statement at 165. And we had it at 120 after the first year. So now we have a gain. The asset has increased by 45, and thus our equity has increased. It's the same entry as a available for sale security. Now we sell it for $13 per share. And now here is where we have the difference. So let's take a look at this. It's an arrow. Hey, Brianna, if you're able to speak, look at this. If you can tell me what looks different in this T account than the one you saw earlier. You see any difference here?
45 is
Well,
on
pardon me?
the 45 is, I don't know.
Okay.
Both.
No, nobody's gonna, it's a little subtle. Let me show you though. Beginning was 0. Remember we had that $30,000 loss the first year? Look at what they did here. They zeroed this out. Remember, we had a $45,000 balance at the end here. Under trading securities, you are going to zero out this net unrealized account and put it into your income statement. You're going to show this as a gain or a loss on your income statement. So if you want to say it this way, everybody, at the end of each month, the balance in the net unrealized account is 0 because you moved it out of the balance sheet into the income statement. So you no longer see that 45,000 floating around. That balance of 45,000 under the AFS was sitting here in the balance. And remember, we had a $45,000 number and a $15,000 number. Look at the journal entry now. You notice, Brianna and everybody, there's only 3 lines to this journal entry. Cash, the asset was valued at 165 when we sold it, and our gain is $30,000. That's $30,000 gain for that year. The prior period, it was a loss of, what was it, $45,000. Under the other method, you would have seen the 45 there, and this gain would have been 15 down here. So let's take a look one more time. That's the only difference, everybody. Under trading securities, you are zeroing out that equity account called unrealized gain on the asset. Okay. Your book doesn't show that journal entry. They don't really follow up on it that much, nor do these slides here. But that's the difference. The treatment of the income. Trading securities, you're showing the income every year. Every year. Trading securities, realized gains, sales price minus book value. Okay, here we go. We're talking about trading securities, sales price less book value. I hate this thing. Sales price greater than book value. Guess what? You have a gain. Otherwise, it's a loss. Here is the key difference. At the end of the year, you adjust, meaning you eliminate this unrealized account, and you're going to show income. You're going to show a loss of 45,000 the first year, and then the gain of whatever it was the next year when it went up to 165. Available for sales, you don't mess around with it. You don't do anything with it until you sell the security. The balance sheet, there is no unrealized gains or losses on a trading security balance sheet. You adjust it and then eliminate it. Here, you're going to keep that balance going year after year if it's an AFS. Now, I know this part of the book is a little bit tricky. It's new. It's a little bit counterintuitive. You're seeing a lot of new accounts. But just get the gist right now that we are writing our asset up or down, adjusting to the market value as needed. And under one method, we're going to show income every year, and that's the trading security. And the other method, we show no income until we sell it. In this case, 3 years later. So that's the poor man's tour of trading securities and available for sale securities, otherwise known as passive investments. Passive, we have no influence. We have no influence. Passive, it's like when I watch my beloved New York Giants play football and I'm rooting for them to score and I get mad when they throw another interception. It's passive. I have no influence, even though I kind of think I do, huh? Passive. You're just a bystander. Now we're going into the second of our 3 thresholds, investments for significant influence. Here, we're going to use a method called the equity method. Equity method. Well, if you buy that much stock in a company, say 45%, the presumption is you bought that stock to push the company around a little bit to your way of thinking. Okay? So the investment category, passive, we just went over. The fair value method. Passive means bonds, debts, and the AFS securities and the trading securities. The significant influence method, significant influence percentage of 21 to say 49 roughly is the using the equity method. Equity method. So let's see what we have here. Well, we bought the stock at cost, and then unrealized holding gains and losses are not recorded. So under this equity method, you do not have that unrealized account. Now, here's the tricky part with significant influence. Since investment carrying amount is adjusted for dividends received and a percentage of the investee's income. Think of it this way, please. Under the equity method, what happens to the company happens to you. If they issue a dividend, you issued the dividend. If they made a profit, you're entitled to a percentage of that profit based on how much stock you own. Equity method. Equity method. What happens to the corporation happens to you. If they issue a dividend, your equity goes down, right? Because when the parent company, if you will, issued the dividend, we know that they debited retained earnings and credited dividends payable. They debited retained earnings. That equity account shows that the equity went down. So if they issue a dividend, your equity goes down in the same percentage. If they make money, you're going to show that as your income, okay? Because under this method, you're not independent of the company. You own too much stock. So here we go. Investments for significant influence. The equity method. You got a check in the mail from the parent company and you're going to debit cash, but guess what? Your equity went down. Why'd it go down? Because when the parent company issued the dividend, their equity went down. So you get a check in the mail from these guys. It's like the company just moving money from one part of it to another. If the company makes money or loses money, you get a percentage of that. So we're just talking 2 journal entries here, but it's a little tricky. It's new. You haven't seen this before. Equity method. Wow, Graham bought 40%. 40% of this $1 million company. Well, we know we're going to debit an asset, and we know we're going to credit cash, I bet, huh? So let's see what we have here. Debit investment in affiliates. Investment in affiliates. An affiliate, what's an affiliate? It's like a subsidiary. KEYT, our local news here in Santa Barbara on Channel 3, is an ABC channel. It is an affiliate of WABC located back in Manhattan, back in New York. The affiliate, sort of the subsidiary. So under the equity method, you're calling yourself an affiliate, okay? Investment in you're an affiliate. An affiliate. So what did we just say? Under this equity method, the affiliates, whatever happens to the parent company happens to the affiliates. So let's see what happened here. Graham's net income for the year was 500,000, right? That means our net income is 40% of that. So let's see what we have here. Look at this, will you? Our investment went up 200,000. And we're crediting an account called equity and affiliate earnings. And I'm not joking, that's a revenue account. Why they call it that to confuse us, I don't know. This equity and affiliate earnings is a revenue account, okay? And that's usually a true false question on the test. I know I love to ask that one. So our investment went up 200,000 and now we're showing income of 200,000, okay? And notice on the bottom, it's verifying what I just said. Give me 1 second here to scrunch over. Note, Graham Holdings credit equity and affiliate earnings, which is an income statement account. Oh, I guess they just wanted to make it difficult for anybody trying to learn this, huh? So what have we learned? We are an affiliate. If the company makes money, we make money. If they issue a dividend, our equity goes down, just like theirs. They paid, the parent company paid $100,000 in dividends. We get 40% of that cash, but we also lose equity. Let's see what we have here. We are going to debit cash for $40,000 and we're going to credit our asset. That's a little tricky to get your arms around, right? How could we receive cash and our investment went down? Because what happens to the company happens to us under the equity method. When you own 40% of the stock, you're now in the threshold called significant influence. And that means if the company makes money, you get that percentage of that. If they issue a dividend, they debited retained earnings for $100,000, and you have to show the impact of that yourself. The equity of the parent company went down $100,000 by issuing this dividend. Therefore, our equity is reduced by the proportionate amount. Affiliates. Equity method reported on the balance sheet, long-term asset, huh? It's increased by the proportional share of the income, and it's reduced by any dividends, okay? No adjustment is made into market value under this method here. Give me 1 second here, I'm just fighting this a bit. Gain or loss reported, that's when you show it in the income statement, okay?
Professor, I have a question.
Sure.
For the, I forget what the account was called, but the one that is the revenue one.
Yes.
So is that closed out at the end of a
No.
period?
No, there's nothing closed out here. This is a totally different world from the passive investments.
Oh, okay.
These balances are just going to keep matching whatever the parent company did. If they made money, you made money. If their equity went down, your equity went down, and it's going to stay the same number until the parent company does something else, okay? There's no zeroing out of anything under the equity method. A little bit confusing, huh? Okay. equity method. Here's our dividends we received. We got cash. That's nice. But it's pretty much the same company. Now we'll finish up with this track meet here. Controlling interest, merger and acquisition. Mergers and acquisitions, pretty much the same thing in that if you buy more than 50% of the company, you control it. And you can choose to merge the company with yours, or you can choose to run it on your own, do whatever you want. If you acquire all the shares, that's an acquisition. And now you've got some accounting to do. So what are we talking about here? Mergers and acquisition. Vaulting over 50%, okay? Mergers and acquisition. This always makes me chuckle there. Mergers and acquisition. Horizontal growth, vertical growth. Let me think about horizontal growth, left to right, huh? Horizontal growth results when a company purchases another company in the same business, okay? If Coca-Cola ever purchased PepsiCo, which I don't think the government would allow, that would be too big a merger. But if Coca-Cola bought out Pepsi-Cola, that would be an example of horizontal growth. Because what you did was you bought a company that sells to your current customers maybe already, and now you got a shot at their customers. Horizontal growth is more of a marketing thing. You're buying companies in the same business. Vertical growth is just that, up and down, vertical. What we mean by vertical integration is General Motors. They make Chevrolets, right? They make cars. Well, if Chevrolet went out and bought a rubber company, that is considered vertical integration. They didn't buy that rubber company to sell tires, probably. They bought that rubber company to provide their raw material, the rubber. If they bought a glass company, same thing. A steel mill. Vertical, you're buying companies that are not in your wheelhouse, not doing what you do. Horizontal, same thing. Synergy, that's a buzzword. Synergy. This is the notion that 1 + 1 = 3. What we mean by that is you acquire another company, and your company is $1 million company, and the other company is $1 million company. But you feel very comfortable that if you buy out that other company and get a shot at their customers, and you get to strut your stuff for those customers and suppliers, pretty soon you're going to have a $3 million company. Synergy. The notion that 1 + 1 = 3, if you will, and that by merging the two companies together, they are stronger than two separate companies. Doesn't always work that way. Who can forget, what was it, AOL and Time Warner? That was supposed to be the greatest merger ever. They were going to do great. They almost put each other out of business. I believe that's who it was, Time Warner and AOL. You can look that up. Interesting little history there. Mergers and acquisitions, huh? Accounted for using the acquisition accounting and consolidation, I guess, method we'll call it though. Mergers and acquisitions. Consolidation versus a consolidation merger, same thing. Consolidation is when one company purchases more than 50% of another, okay? Now you own the other company. So when your company provides financial statements, you are going to have their investing information. That company is going to be involved with your world. You're going to have to come up with some consolidated financial statements, meaning the activities of the two companies are molded into one reporting to the public. Now, you might show
an income statement for your company and the separate income statement for the company that you now own, the second company. That's fine. But ultimately, they need to be consolidated into one financial statement that the world is going to see. Consolidation, the acquired and acquiring companies continue their separate legal existence, and you prepare consolidated financial statements. And we don't have a course like that here, but that's an interesting class to take, all about accounting for consolidations. There are eliminating entries and some very interesting things that those of you who go on with accounting will be certainly learning. If you own all the shares of that company is done. The consolidated look the same as if the companies had been combined into one company. And here are some rules. Merger, one company puts all the assets of another and the other guys go out of business. The acquiring company treats the acquired assets as if they were their own, and the assets and liabilities are recorded at fair value on the date of the merger. So let's back up and try to digest this a little bit, okay? I said a consolidation and a merger, the same thing, not quite. Consolidation is you're going to take their separate financial statements and mold them into yours. A merger is when you buy all of their net assets and you choose to put that company out of its misery. I don't mean you fired anybody. I don't mean that you made any changes necessarily. It's just that when Coca-Cola bought out Pepsi-Cola, well, now Coca-Cola is the name of the company. There's no more Pepsi-Cola in the sense of a separate entity. It's now part of this new company. And when that happens, the acquiring company treats the assets and liabilities as if they had been acquired individually. Well, that makes sense. When you buy a company, you bought their balance sheet, right? You bought their assets, liabilities, and investments. So when you buy another company, you're going to debit cash for the amount of cash they had. You're going to debit accounts receivable, etc. But there are a couple little tweaks here. The assets and liabilities are recorded at the fair value, the fair market value on the date of the merger. So you bought a company that had $100,000 in the bank and it had 200,000 of receivables. Okay, well, that's the fair value. You debit cash 100, you debit receivables 200. But then you came to their property. You came to the land. This company bought land 75 years ago for $100,000. And as we all know, that 75,000 continues to be the value on that company's general ledger. Well, when you buy this company, you're not going to debit it for 75,000. You're going to debit it for maybe, say, 10 million, which is what it's worth today. Fair value. Goodwill is computed and reported. We're going to go over goodwill. It's simply the difference between what you paid for the company and its fair market value. What are consolidated financial statements? The acquiring company is the parent. The company that was purchased is called a subsidiary, and their consolidated statements are combined into a single set. Again, you might keep the separate income statement for the other company, but it must be molded in, must be consolidated. And here's what I was briefly mentioning about eliminating. Any transactions between the parent and subsidiary must be eliminated. Don't worry about that. That's a whole different world. Let's talk about goodwill. Let's do some goodwill hunting, if you will, okay? Goodwill. It occurs when one company buys another company. It's an intangible asset. Purchased goodwill is an intangible asset, okay? It is the amount by which the purchase price exceeds the fair market value of the net assets. So you have your eye on this company. It's $1 million company.
and you think it's worth, you value that company at $1 million, okay? You've looked at their land and their buildings and equipment, and the fair market value is much higher. So you think that company's worth $1 million. And you go to the owner and you say, hey, I'll give you $1 million for the company. And the owner says, no, no good. You come back later and how about $1.1 million? No good. Eventually, maybe he says, give me $1.5 million and I'll sell my $1 million company. And you may do that. You may do that if you think you can really make money with that company. You think that their management's been terrible. You take it over. Yeah, you're going to pay that extra amount. So here we go. Recording a merger. A merger, like when you're getting into traffic and all the cars merge together. Huh? Graham Holdings paid $1 million in cash. Now they originally bought, what was it, 15%? Then they bought 40%. In this scenario, they just bought everything. Graham Holdings merged iNews operations into its own operations, and iNews ceased to exist as a separate company. Now, that doesn't mean that Graham Holdings took it over and then fired everybody and closed everything down. No. In fact, they may have even put more money into iNews. The point is that iNews is no longer a separate company. And here's the information about what they purchased. Fair value of the equipment. They say that the fair value of the equipment is $350,000. iNews was carrying that equipment for, say, $40,000, just to make up a number. Okay, iNews paid $40,000 for that equipment many years ago. Now, Graham says we know that equipment is worth $350,000, and they did that systematically and rationally. They looked at what others are paying for that type of equipment now. They looked at the condition. So the fair value of the equipment is $350,000. The fair value of the patents is $600,000. Total fair value of the assets is $950,000. When you buy a company, though, you also buy their payables. So the fair market value of this company, according to Graham, is $850,000. What did they pay for this company? $1 million. They paid $1 million for a company that they admit is only worth $850,000. And they did that for strategic reasons. Remember the synergy, 1 + 1 is 3. Remember the horizontal growth? This is probably an example of that. Recording a merger. So they're obviously not showing the entire balance sheet, but they want to make the point, and I think they do it well here. Well, let's see. We bought this company for $1 million. We think the equipment is worth $350,000. We think the patents are worth $600,000 and the goodwill is worth this. They had this note payable of $100,000 and we credit cash. $350,000 plus $600,000 is $950,000. And here we come $1050,000. We are paying $1 million for a company that we believe is worth, what was the number? We believe this company, the value of it is really $850,000, but we're willing to pay $150,000 more because we really want to get hold of that company. Okay. Goodwill. It's a tricky area. No question about that. You're seeing something new here. And goodwill is not amortized. You don't need to know this, I don't think. Goodwill is not amortized. It used to be. Subject to the assessment for impairment. Just like any other asset, if it's lost its value, you must write it down. I don't think we need to address that here. And make sure you memorize this chart. No, not really. You might find this helpful. I don't know. But what they're saying, this is just your classic
How will we invest in the company? We're going to buy bonds. Well, if they're bonds, we know they're passive. We're going to buy stock. Is it going to be passive, or is it going to be significant, or is it going to be controlled if it's significant? Anyway, this grid may be helpful to you when you're doing your homework or trying to get through some exercises or writing up your summary, okay? Cash flows, we're not going to worry about that because I believe our very next chapter is all about cash flows. And we are done with our appendix operation. I hope this was helpful. What do you think, Brianna? You got any comments here?
No, that was good.
You agree it's a little tricky, or you feel like you're pretty much hanging in there with me?
After I do my own summary and organize it in my own head, it seems fairly simple.
Yep, good answer. Good to hear. Okay, well, I guess we'll call it a class then, huh? Oh, by the way, Brianna in class, do you mind if I end up with one bad joke here? Remember we were talking about affiliate? Remember that word, Brianna?
Yep.
When I was in grammar school, the nuns were teaching us words like that. And the word that I was given was officiate. You know, like you referee a basketball game, officiate. And the nun asked me to use that word in a sentence. And even back at 10 years old, I was a wise guy. I said, I can use that word in a sentence. I said, my uncle got sick from officiate.
That's great.
Yeah, that quiet reaction is usually what I get with that joke. Anyway, the nuns didn't like that. Hey, you have a good weekend, you and Landon and everybody, okay?
All right, thanks. You too.
See you later. Bye-bye.